Look at your screen right now. Silver is trading at $72 an ounce. $72. 6 months ago, it was $28. A year ago, analysts said $35 was optimistic. 2 years ago, the idea of $50 silver was considered a fantasy peddled by precious metals extremists. But now we're at $72 and climbing. This is not a drill. This is not a hypothetical scenario we're gaming out. This is happening right now, today, as you watch this video. But here's why you clicked on this video. Here's what you already sense in your gut but need someone to say out loud. This doesn't feel right. The move is too fast, too vertical, too perfect. Every day, new highs. Every dip, bought instantly. Social media is euphoric. Reddit is celebrating. Your coworker who's never invested in anything is suddenly asking about silver stackers. But if you've been in markets long enough, you know what this looks like. You've seen this movie before. You know how it ends. The question burning in your mind, the reason you're here is simple. Is silver about to crash? Your Asian friend is going to answer that question today. But first, you need to understand that what's happening right now has happened before. Twice. And both times, it ended in devastation. In 1980, two brothers from Texas tried to corner the entire silver market. Nelson Bunker Hunt and William Herbert Hunt accumulated over 100 million ounces of silver. They drove the price from $6 to nearly $50 in less than a year. That's a 700% gain. The financial world had never seen anything like it. But then, in a single day, one trading session, silver collapsed by 50%. The Hunt brothers were wiped out. Investors who followed them into the trade lost everything. What had looked like the opportunity of a lifetime became financial devastation overnight. The day became known as Silver Thursday. It's a wound the precious metals community still carries. Now fast forward to 2011. Silver makes another historic run. It climbs from $18 to $49 in just 7 months. The narrative was compelling. Quantitative easing, dollar collapse, inflation hedging. Everyone was buying. But then it crashed from $49 to $14 over the next few years, a 70% wipeout. But here's what should terrify you. I woke up this morning and silver was trading around $72 an ounce. That's a move from $20 to $72 in what feels like the blink of an eye. We've blown past the 1980 Hunt brothers peak. We've shattered the 2011 high. We're in uncharted territory. But every single time silver has made a move like this, a vertical, parabolic, euphoric spike, it ended the same way, not with a gentle pullback, with a violent portfolio-destroying crash that catches everyone off guard. The question you need to answer right now, today, before this video ends, is this. Is this the beginning of a new precious metals supercycle? A fundamental repricing driven by AI, industrial demand, and the collapse of fiat currencies? Or are we watching the final manic blow-off top of a speculative bubble that's about to implode? Because if you get this wrong, you will pay the price. Let me show you both sides of this trade and what I think happens next. Let's talk about what just happened. Because the speed of this move is not normal, it's not healthy, but it has every hallmark of a speculative frenzy that ends badly. Silver was trading around $20 an ounce in late 2022. Just over 2 years later, we're looking at $72. That's a 260% gain. To put that in perspective, the S&P 500 returned about 25% annually during one of the greatest bull markets in history. Silver just tripled that in half the time. But here's what you need to understand about parabolic moves. They don't happen because of fundamentals, not in the short term. They happen because of fear, momentum, and greed feeding on each other in a self-reinforcing loop. Let me break down the psychology of what's driving this. First, war. Gold is for war. It always has been. Central banks don't stockpile gold because they think it's pretty. They stockpile it because gold is currency during conflict. It's the one asset that holds value when treaties break down, when alliances shatter, when the unthinkable happens. But right now, the world is more dangerous than it's been in decades. Russia and Ukraine, Israel and Gaza, tensions in the Taiwan Strait, the Middle East on the brink. When gold starts moving, really moving, it's because people with access to information we don't have are positioning for something bad. The chart knows before the headlines do. Gold broke out first. It ran from $1,800 to over $3,200. And silver? Silver follows. It always follows. But here's the thing about silver. It's the retail version of gold. It's the fastest horse. When institutional money flows into gold, retail money piles into silver because it's more accessible, more volatile, and offers more upside on a percentage basis. That's exactly what we're seeing now. Retail investors, precious metals enthusiasts, and speculators are flooding into silver, chasing the move, convinced that $100 is just around the corner, maybe $150. Some are calling for $200. But they're pointing to one number to justify it all, the gold to silver ratio. Let me explain why this ratio is both incredibly compelling and incredibly dangerous right now. Historically, the gold to silver ratio has averaged somewhere between 51 and 61. That means it takes 50 to 60 ounces of silver to buy 1 ounce of gold. At its extremes, we've seen this ratio spike above 100.1 during periods of fear and collapse below 30.1 during silver manias. When silver started this run, the ratio was around 80.1. Today, it's compressing rapidly. We're approaching 45.1, maybe 40.1 depending on the day. But bulls are pointing to this and saying it's going lower, much lower. But here's where it gets interesting and where the real believers get aggressive. Annual gold production is approximately 3,200 tons. Annual silver production is approximately 25,000 tons. Do the math. That's roughly 8.1, 8 to 1. Not 80.1, not 50.1, 8 to 1. If silver were priced based purely on its scarcity relative to gold, we're talking about $400 silver, $500 silver. If gold goes to $10,000 over the next few years, which some analysts believe is possible in a prolonged crisis, then silver at a 50.1 ratio is $200. At an 8:1 ratio, it's over $1,000 an ounce. This is the narrative driving the mania. This is why people are buying hand over fist, why premiums on physical silver are through the roof, why every dip gets bought within hours. But here's the first twist you need to hear, the one that the bulls don't want to talk about. The fundamentals cannot support this price. Not yet, not at this speed. The ratio argument is seductive, but it ignores a critical reality. Silver has always traded at a discount to its production ratio because of how it's used and how it's perceived. Industrial demand, recycling, above-ground stockpiles. These factors have kept silver suppressed for decades. The ratio hasn't been at 8:1 in modern history. It hasn't even been at 15:1 since the 1970s. For that ratio to compress to historic lows, you need a fundamental shift in how the world values silver. That takes time. That takes structural change. It doesn't happen in 6 months because retail traders got excited. But when I look at the charts right now, I don't see organic, sustainable growth. I see froth. Look at the volume spikes. Every major leg up has been accompanied by record trading volumes in silver futures and ETFs. That's not accumulation by patient, long-term investors. That's hot money chasing momentum. It's the same signature we saw in 1980, the same signature we saw in 2011. Look at the RSI, the Relative Strength Index. Silver is deep in overbought territory on the daily, weekly, and monthly charts. We haven't seen readings this extreme since the blow-off tops of previous cycles. When an asset is this overbought, it doesn't mean it can't go higher. It means the risk of a violent reversal is exponentially higher. Look at retail sentiment. Social media is flooded with silver content. YouTube videos calling for $200 silver are getting millions of views. Reddit forums are euphoric. When your Uber driver starts asking about silver stackers, when your coworker who's never invested in anything suddenly wants to know about physical bullion, that's a sentiment indicator, and it's flashing red. One market veteran I follow put it perfectly. It's high. It's doing a damn good impression of a vertical final move. A vertical final move. That's the phrase that should be burned into your brain right now. Because vertical moves don't end with gentle pullbacks. They end with crashes. The steeper the ascent, the more violent the descent. That's not opinion. That's the physics of markets. At $80, smart money will be sweating. At $100, the warning sirens will be deafening. But somewhere between here and there, or maybe just beyond, we will see a correction that wipes out months of gains in days. The question isn't whether silver can go higher from here. It absolutely can. Manias can last longer and go further than anyone expects. The question is whether you understand that you're riding a tiger, but tigers eventually turn around and bite. But wait, we're not done. Because there's a second layer to this story. A long-term thesis that's actually compelling, actually grounded in real-world demand. It involves artificial intelligence, the greatest industrial build-out in human history, and a supply crunch that could take a decade to resolve. But that thesis, as powerful as it is, might be running a decade ahead of itself. And that gap between the narrative and the reality, that's where fortunes get destroyed. Now let me show you the other side of this trade, because the bulls aren't crazy. They're not delusional. They're seeing something real, something that could fundamentally reshape the commodity landscape for the next 50 years. And it all comes down to two words: artificial intelligence. Here's the thesis. I want you to understand it fully before I tear it apart. We are standing at the beginning of an industrial revolution, not a metaphorical one, a literal one. The last time humanity experienced a technological shift this profound was the transition from agricultural society to industrial society, the age of steam engines, mechanization, and factory production. That revolution took a population where 95% were farmers, living on the land, dying in their 40s, watching 80% of their children perish before age 5, and transformed it into the modern world where we live to 85 but take abundance for granted. That was the age of artificial muscle. Machines that could do physical work. This is the age of artificial brain, machines that can think. But just like the last industrial revolution consumed resources at a scale no one anticipated, coal, iron, steel, oil, this revolution will consume resources at a scale that will reprice every commodity on the planet. Let me give you the numbers, because the numbers are staggering. The AI build-out currently underway represents approximately $1.5 trillion in infrastructure investment over the next 10 months, not 10 years. 10 months. We're talking about data centers the size of small cities, server farms that span areas half the size of Manhattan, computing clusters that require their own dedicated power plants just to function. And every single one of these facilities runs on electricity. Massive, unprecedented amounts of electricity. Here's what most people don't understand about AI. The models themselves, the GPTs, the Claude systems, the neural networks. They're not the constraint anymore. We can make them smarter, faster, more capable. The constraint is power. Raw electrical power. A single advanced AI data center can consume as much electricity as a mid-sized city. But we're not building one or two of these. We're building hundreds, globally, simultaneously. In a race where second place might as well be last place. China doesn't want to be in second place. America doesn't want to be second place. Europe, if it wants to survive as an economic power, cannot be in second place. This is not speculation. This is happening right now. But the energy requirements are so extreme that something unthinkable is occurring. Nuclear power is back. Think about that for a moment. 6 months ago, if you publicly advocated for building nuclear power plants, you would have been politically radioactive, pun intended. Environmental groups would have mobilized against you. Politicians would have distanced themselves. The green energy orthodoxy had declared nuclear verboten. But now they're talking about building 400 new nuclear reactors. Not because anyone suddenly changed their mind about the environment, because there's no other way to power what's coming. Solar and wind cannot provide the base load capacity. Natural gas cannot scale fast enough. Coal is political suicide. But nuclear is the only option that can deliver the terawatts this revolution demands. But here's where it gets interesting for precious metals investors. You cannot run power cables made of aluminum. Well, you can try. It won't work well. The conductivity losses are too high. Long-distance power transmission requires copper. Transformers require copper. The entire electrical grid that will connect these nuclear plants to these data centers requires copper at a scale that dwarfs current production capacity. And silver? Silver is one of the most conductive elements on Earth. It's used in virtually every electronic connection, every solar panel, every advanced semiconductor. Data centers don't just use silver, they devour it. Every server rack, every connection point, every piece of advanced equipment contains silver components. The same is true for platinum and palladium. The green energy transition that was supposed to kill internal combustion engines, it's being walked back. America under Trump said no to forced electrification. Europe just pushed back its ICE ban by 5 years, and everyone knows that means it's never happening, which means catalytic converters, which require platinum and palladium for pollution remediation, will be in demand for decades longer than anyone projected. So here's the bull case in its purest form. We are entering a period of reindustrialization on a global scale. Manufacturing is being onshored because you cannot have your geopolitical rival, but let's be honest. China is now openly discussed as a strategic adversary, making all your critical components. The supply chains are being repatriated, the factories are being rebuilt, and every factory, every robot, every piece of infrastructure requires commodities. Meanwhile, we have systematically underinvested in mining for 2 decades. The "we don't want heavy industry here" mentality pushed extraction overseas. Environmental regulations made new projects nearly impossible in developed nations. The pipeline of new mines has dried up. But now, suddenly, we need everything, all at once. More copper, more silver, more platinum, more palladium, more rare earth elements, more of everything. The conclusion some analysts are reaching is radical but logical. Commodities will stop being commodities. They will become luxuries. A fundamental repricing is coming that will make today's prices look like a bargain, if that thesis is correct. If we really are entering a multi-decade supercycle driven by AI and reindustrialization, then $72 silver isn't expensive. It's cheap. $100 silver is cheap. $200 silver is cheap. The production ratio of 8.1 relative to gold starts to look like the real target. So why am I worried? Here's the second twist. The ticking time bomb that no one wants to discuss. The thesis is about the next 10 to 20 years. The price action is about the next 10 to 20 weeks. There is a timeline mismatch so severe, so structurally dangerous, that it could cause a crash, even if the long-term thesis is completely correct. Let me explain. It takes 5 to 10 years to bring a new copper mine online. 5 to 10 years. That's from discovery, through permitting, through construction, through production. A mine that starts development today won't produce meaningful output until 2030 at the earliest. More likely 2032 or 2033. It takes similar timeframes for silver mines, for platinum mines, for any major extractive operation. These are not businesses where you can just ramp up production to meet demand. The geology is the geology. The permitting is the permitting. The construction is the construction. But the AI build-out, that's measured in months, quarters at most. The demand surge is happening now, and it's accelerating with each passing week. So yes, long term, we face a structural supply deficit. That part of the thesis is solid. But short term, the price has already been priced in years of that deficit. The market has front-run the entire decade of scarcity in a matter of months. Silver isn't trading at $72 because industrial users are desperately buying today. It's trading at $72 because speculators are betting on what industrial users will need in 2030. But that gap between the current speculative price and the current fundamental reality is where the crash lives. Because here's what happens if anything goes wrong with the AI timeline. What if the build-out slows? What if regulatory concerns about AI cause governments to pump the brakes? What if the hallucination problem in large language models proves harder to solve than expected? What if the next generation of chips hits unexpected technical barriers? What if the energy build-out hits obstacles? What if those 400 nuclear reactors face permitting delays, construction cost overruns, NIMBY opposition? What if the copper and silver needed to build the grid can't be produced fast enough to build the grid? Do you see the circular trap? You need commodities to build the infrastructure, to power the AI that creates the demand for the commodities. But if any link in that chain breaks, even temporarily, the speculative premium in today's prices evaporates instantly. The market is priced in a perfect execution of the most ambitious industrial build-out in human history. It has priced in no delays, no obstacles, no policy reversals, no recessions, no geopolitical disruptions beyond the current ones. That's a lot of optimism baked into a vertical price chart. But here's the darkest part of this timeline mismatch. Even if everything goes right, we're still vulnerable. Because the institutions that set the rules of the game, the CME, the CFTC, the futures exchanges, they have a tool they've used before to crush precious metals rallies. It's called margin requirements. And they can change the rules overnight. In 1980, when the Hunt brothers were cornering silver, the COMEX changed the rules. They raised margin requirements so high that leveraged longs couldn't hold their positions. The forced liquidation crashed the market in days. They could do it again. Silver goes to $90, $100, starts threatening financial stability or the perceived credibility of the dollar, and suddenly the exchanges announce emergency margin hikes. Leveraged longs get margin calls they can't meet. Selling begets selling. The price collapses before the fundamentals ever have a chance to catch up. The fundamentals say silver should be worth more long term. The mechanics of the market say the price can be destroyed short term by regulatory intervention, liquidity events, or a simple change in sentiment. Both things can be true. But if you don't understand that, you're not an investor. You're a gambler who doesn't know the house can change the rules mid-hand. We're heading toward the most volatile period for silver since 1980. What comes next will determine whether this generation of precious metals investors builds generational wealth, or learns the same lesson the Hunt brothers learned. Let me now synthesize everything we've discussed into a coherent warning. Because what I'm about to tell you isn't speculation, it's pattern recognition. And the pattern is screaming that we are approaching a moment of extreme volatility that will catch most investors completely off guard. Here's the thesis in its clearest form. Silver is in a classic bubble formation. The long-term fundamentals are real, but the short-term price action has detached from reality. A violent correction is coming, not as the end of the silver story, but as a brutal reset that will shake out weak hands before the next leg higher. Let me show you exactly how this plays out, what triggers to watch for, and how to position yourself on the right side of history. First, let's establish what we know for certain. Silver has gone parabolic. The move from $20 to $72 represents a 260% gain in roughly 2 years, with the majority of that move compressed into the last several months. This is not normal price appreciation. This is a speculative mania in progress. The gold to silver ratio has compressed from 80.1 to approximately 45:1 and is still falling. Bulls are pointing to the production ratio of 8:1 and arguing that silver has much further to run. Bears are pointing to historical norms and arguing the ratio rarely stays below 41 for long. Technical indicators are at extreme levels. RSI is overbought on every time frame. Volume spikes accompany each new high. Retail sentiment is euphoric. Social media is flooded with price targets that would have seemed insane 12 months ago. The fundamental demand thesis, AI, reindustrialization. Energy build-out is real, but operates on a 5 to 10 year timeline. The price action has front-run this thesis by years, creating a gap between speculative valuation and current industrial reality. But critically, the mechanisms that have crushed silver rallies in the past, such as margin requirement changes, regulatory intervention, liquidity crises, remain fully operational and could be deployed at any moment. Now let me walk you through the anatomy of how this crash will unfold. Stage 1, the final blow-off. Top. We're in this stage right now, or very close to it. The price is rising on momentum, not fundamentals. Each new high brings in more buyers, which drives prices higher, which brings in more buyers. This is the definition of a reflexive feedback loop, but these loops always break. One experienced market analyst I follow identified $80 as the key psychological level where smart money will start sweating. That's not because $80 is some magical number. It's because round numbers act as psychological magnets in markets. They attract attention, concentrate orders, and create natural decision points. At $80, large holders will start reducing positions. Not selling everything, just trimming risk, taking some profits off the table. They've seen this movie before. They know how it ends. If silver pushes through $80 with conviction, the next target is $100. Another round number, another psychological magnet. But $100 silver will create a media frenzy unlike anything we've seen. CNBC will cover it. Bloomberg will analyze it. Your coworker who never bought an ounce of precious metals will suddenly want to know how to open a brokerage account. That's the signal that we're at peak euphoria. When the mainstream media discovers a move that started years earlier, you are almost certainly in the distribution phase, the period where smart money is selling to dumb money. Some analysts are calling for $130, some are calling for $200. But here's the brutal truth about tops. They're almost impossible to call in real time. The final high could be $95. It could be $115. It could be $147 on some random Tuesday that no one predicted. But here's what one veteran trader told me, and it should be tattooed on your forearm. The top could be $130, but the day before it hit $130, it could have been $97, and the day after, it could be $105. Read that again. The blow-off top might last 4 hours. 4 hours of euphoria followed by months of destruction. If you're not watching the market in real time on the exact day it happens, you will miss it. But by the time you realize what happened, you'll already be underwater. This is why timing tops is a fool's game. Which brings us to the next stage. Stage 2, the trigger event. Every bubble needs a pin, something that pops the mania and reverses the psychology from greed to fear. In silver, there are several potential triggers, but any one of them could be the catalyst. The most likely trigger is margin requirement changes by the CME or COMEX. Here's how this works. When you trade silver futures, you don't put up the full value of the contract. You put up margin, a percentage of the total value. This allows traders to control large positions with relatively small capital. It's leverage. When silver prices rise rapidly, the exchanges become concerned about systemic risk. If prices suddenly reverse, leveraged longs could face losses greater than their account balances. The exchange itself could be on the hook, so they raise margin requirements, forcing traders to either deposit more capital or liquidate their positions. This is exactly what happened in 1980 during the Hunt brothers squeeze. The COMEX raised margin requirements repeatedly, specifically targeting silver. Traders who couldn't meet the new requirements were forced to sell. The forced selling created more price declines, which triggered more margin calls, which created more forced selling. It's a death spiral, and it can crash a market in days that took months to build up. If silver approaches $100 or shows signs of destabilizing broader financial markets. I expect the CME to raise margins aggressively. They'll call it risk management. They'll say they're protecting market integrity, but the effect will be the same. A wave of forced liquidation that crushes the price. The second potential trigger is dollar strength. Silver is priced in dollars. When the dollar strengthens against other currencies, silver becomes more expensive for foreign buyers, reducing demand and pressuring prices. We've seen periods where dollar strength single-handedly reversed precious metals, rallies even when fundamentals were supportive. If the Federal Reserve signals higher for longer interest rates, if geopolitical crisis causes a flight to dollar safety, if any number of macro factors push the dollar index higher, silver could face significant headwinds regardless of its own supply-demand dynamics. The third potential trigger is a liquidity crisis. In 2020, when COVID panic hit markets, everything sold off initially, including gold and silver. Why? Because when liquidity evaporates, traders sell what they can, not what they want to. Precious metals, despite being safe havens, are liquid assets that can be converted to cash quickly in a true liquidity crunch. They get sold alongside everything else. If we experience a market-wide deleveraging event, a hedge fund blowing up, a banking crisis, a sovereign debt scare, silver could crash even as the fundamental reasons to own it grow stronger. This is the cruel irony of markets. The best long-term assets can suffer the worst short-term drawdowns during crisis periods. Stage 3, the crash itself. When the trigger hits, the reversal will be violent. Energy build-out, supply deficits. This isn't speculation, it's the physics of parabolic moves. The steeper the ascent, the steeper the descent. Look at the 1980 example. Silver went from $49 to $11 in 2 months. That's a 78% drawdown. Investors who bought at $40, thinking they were getting in early, lost 3/4 of their money. Look at the 2011 example. Silver crashed from $40 to $26 in a matter of weeks, a 47% drawdown. Before continuing lower to $14 over the following years, anyone who spent above $35 spent years underwater, watching their investment bleed value month after month. Now imagine you buy silver at $85 because you're convinced it's going to $150. The crash takes it to $45. You're down 47%. For you to break even, silver needs to rally 89% from that level. That could take years. In the meantime, you're trapped in a losing position, watching your capital decay while other opportunities pass you by. This is why understanding the crash mechanics matters. Even if you're long-term bullish, the destination might be $200 silver, but the path to get there might include a stop at $35. That destroys everyone who didn't respect the short-term risks. So what are the likely support levels if a correction hits? The first major support zone is $50 to $55. This was the 1980 high and the 2011 high. Those old highs often become new support during corrections. Expect significant buying interest in this zone if we see a pullback. The second major support zone is $35 to $40. This represents approximately a 50% retracement from current levels and aligns with previous resistance zones that should now act as support. A crash to this level would be painful but not unprecedented. The nuclear scenario, the outcome no one wants to contemplate, would take silver back to $22 to $25. That's roughly where this entire bull run started. A return to those levels would represent a complete retracement of the entire move, an outcome that would devastate the precious metals community, but would also create the buying opportunity of a generation. I don't think the nuclear scenario is likely, unless we get a combination of margin hikes, dollar spike, and the liquidity crisis simultaneously. But unlikely doesn't mean impossible. And in markets, the unlikely happens regularly enough that you must plan for it. Stage 4, the aftermath and the opportunity. Here's where I need you to hold two ideas in your head simultaneously, because both are true. A crash is coming, but the crash will be the best thing that could happen for long-term precious metals investors. Let me explain. The fundamental thesis we discussed earlier, AI demand, reindustrialization, the 8:1 production ratio, none of that goes away because of a price correction. The data centers still need to be built, the power grid still needs to be upgraded, the mines still take a decade to develop. The structural scarcity is still structural. What a crash does is reset the speculative premium. It shakes out the weak hands. It destroys the leveraged longs who are only in it for quick profits. It takes silver from everyone's talking about it to nobody wants to touch it. But that moment of maximum pessimism, when silver is pronounced dead by the financial media, when your friends who were so excited about their silver investments refuse to discuss it, that's when generational fortunes are made. The investors who bought gold at $300 in 2001, when nobody cared about precious metals, they built wealth that transformed their families. The investors who bought after the 2008 crash, when fear was at its peak, rode a decade-long bull market to extraordinary gains. The opportunity isn't buying silver at $72 because you think it's going to $150. The opportunity is being patient enough to wait for the crash, brave enough to buy when blood is in the streets, but disciplined enough to hold through the next cycle. That might mean sitting on the sidelines for months. It might mean watching silver go to $90, $100, even $120 while you hold cash. It will test your conviction. It will make you question whether you were wrong. The fear of missing out will be almost unbearable. But if you understand the pattern, if you've internalized everything we've discussed today, you'll know that your moment is coming. The crash always comes, but for those who are prepared, the crash is the gift. But what signs must you watch for? I want to give you specific signals that will confirm the top is in, not predictions. No one can predict the exact day, but patterns that have preceded every major precious metals crash in modern history. First, watch for a divergence between price and momentum. If silver makes a new high, but RSI or MACD makes a lower high, that's a warning sign. It means the buying pressure is weakening even as prices rise. This is called a bearish divergence, and it's one of the most reliable topping signals in technical analysis. Second, watch for a failed breakout. If silver pushes above a major round number, say $80 or $100, but can't hold it and closes back below, that's a potential top signal. Failed breakouts often precede significant reversals. Third, watch for volume exhaustion at market tops. You often see a final high volume spike that represents the last rush of buyers. If silver has a huge volume day, makes a new high, but then closes well off its highs, that could be the blow-off candle that marks the end. Fourth, watch the mainstream media. When silver gets sustained coverage on major financial networks, when newspapers run front-page stories about the precious metals boom, when your relatives start asking about it, that's a sentiment indicator of extreme proportions. Media coverage is a lagging indicator by the time they notice. Smart money is already selling. Fifth, watch the gold to silver ratio. If the ratio suddenly reverses and starts expanding, meaning silver starts underperforming gold, that's often an early sign that the speculative trade is unwinding. Silver leads on the way up and leads on the way down. And finally, watch the CME announcements. Any mention of margin requirement changes should put you on high alert. This is the kill switch they've used before, but they won't hesitate to use it again if they perceive systemic risk. The bottom line. We are in the late stages of a speculative frenzy in silver. The price has risen too far, too fast, driven more by momentum and narrative than by actual industrial demand. A correction is coming, probably a severe one, but the correction is not the end of the story. It's the violent reset that every secular bull market requires to shake out weak hands and create a new base for the next leg higher. The AI revolution is real. The energy build-out is real. The supply deficits are real. These forces will drive commodity prices higher for years to come. Silver will likely see prices that would seem insane today, $150, $200, maybe higher, before this cycle is complete. But not in a straight line, never in a straight line. The path to those prices runs through a valley of destruction that will wipe out the impatient and the overleveraged. Only those who understand the pattern, who respect the short-term risks while maintaining conviction in the long-term thesis, will be positioned to capture the full upside. So what should you do? If you're sitting on significant gains, consider taking some profits. Not all. If the long-term thesis is right, you want exposure, but enough to reduce your risk and give you capital to deploy when the crash comes. If you're thinking about buying here, exercise extreme caution. You might be buying near a top that won't be revisited for years. The best case scenario is you catch a final 20-30% move higher. The worst case scenario is you're underwater for half a decade. If you're on the sidelines with cash, your patience is about to be rewarded. The opportunity you've been waiting for. The chance to buy silver at prices that actually represent value rather than speculation. That opportunity is coming. Stay vigilant, stay liquid. But be ready to act decisively when fear replaces greed. This is the moment the pattern warned us about. 3 times in the last 50 years, silver has gone parabolic and then crashed. We're watching the 4th time unfold in real time. Don't be a victim of the pattern. Be a student of it. The crash is coming. But for those who are prepared, it will be the opportunity of a lifetime. Now look, this is my analysis. My opinion is based on the patterns I'm seeing. You may agree, you may not, but ultimately, the decision is yours to make. But if this analysis resonated with you, consider subscribing.